We ready to do this today?
We're serious today. We've got jackets on. We're talking about taxes.
Holy
it's serious.
cow. I love that when you meet somebody and they come into your office or you meet them and then you go pull them up on LinkedIn and you're like, dude, that's an old picture on LinkedIn.
You're doing great, Jason.
Oh, I am?
Yeah. Yeah.
On the aging part?
I don't know, aging part.
Well, you can't stretch before you get warm because then you get hurt.
All right.
So
we'll
I don't know.
We'll have a whole show about that. We'll bring on an expert because neither one of us are experts on that either.
Welcome back. It's Financial Detox. We're glad to be here today. I'm Jason Labrum, your host in studio with
Alex Klingensmith.
What's up, Alex? How are we doing, buddy? We ready to do this today?
We're serious today. We've got jackets on. We're talking about taxes.
Holy cow. Why are we so dressed up?
Picture day.
Oh, well,
and we're having an event.
There you go. Picture day. Oh, are you trying to do your portrait photo today?
I was thinking about it.
You should do it. You look great.
Okay, thanks.
School picture.
Yeah. School picture day.
It's someone said I look too young on the website, so they're like, no, that's not really what you look like today. So you need to get a new picture that's like accurate of your current age.
I love that when you meet somebody and they come into your office or you meet them and then you go pull them up on LinkedIn and you're like, dude, that's an old picture on LinkedIn.
So it's called out like the rest of the firm. We're all going to take pictures in the next day or two to be in 2025.
Hey, one of my pictures that I use regularly is from like 2014. That's 10 years ago.
Is that the one on the thumbnail for social media for this show?
Probably. I don't know. Don't dig.
Don't show that. Yep.
Oh yeah. Do
gosh.
it. You can show it.
I think it's fine. There's it's okay to have different kinds of pictures about of you floating around on the internet. It's normal.
They get to see the evolution of your growth and your aging like a fine wine. You watch it in your wine cellar, right?
There you go. There you go. You're doing great, Jason.
Oh, I am.
Yeah.
On the aging part.
On the aging part. Yeah.
On all things.
I get injured in warm-ups now. You used to get injured in the actual sport or the actual event, but now I get injured doing the warm-up for the event. So I'm starting warm-ups to warm-ups.
There might be
a warm-up.
That's called stretching. And there might be an opportunity, by the way, for you to just accept where you are. Do the stretching, bro. Do the prep work. Like our clients about this, talk about taxes, learn about the foundations, and then apply them when it's game time.
Well, you can't stretch before you get warm because then you get hurt.
All right.
So
I don't know. We'll have a whole show about that. We'll bring on an expert because neither one of us are experts on that either.
I don't think this is making the final cut.
No. Is this like a kinesiologist or something? Is that what we need?
Yeah.
Physical therapist, something.
Totally.
Okay. All right. We're rocking. Today we are going to talk about tax drag. This is important. We're going to be quick, go through some things, give you a couple good visuals, and you are welcome to give us a call. You can click below. You can subscribe and like and all that fancy stuff. But most importantly, if anything we say today, or if everything we say today resonates with you and you are thinking, wow, I need that, then call us because this is what we do. Financial Detox is our consumer education brand where we help people avoid toxic advice, manage their wealth for maximum impact. Very sexy subtitle. But we also have a wealth management firm called IDA Wealth, and IDA Wealth is where a lot of Financial Detox lives and ultimately where we help people implement all the things we talk about on Financial Detox. It's fun. So, Alex, you did a great job prepping this show. You and your best friend ChatGPT are just getting phenomenal at this. And
our relationship has grown to be quite well.
It knows you. I was like, hey, Alex, welcome back for the 5th time today. What other work can I do for you?
It speeds up the work I do. It doesn't do the work I do, which is a whole thing. No, but the reason why I thought this would be a good topic today, kind of two and threefold. One is that our tax team just finished tax season. They sit really close to my office here. Yep. So it's May 1st today. Happy May. And just 2 weeks ago was the first deadline, April 15th deadline. So a lot of people try to do tax planning before that deadline. Not a good time to do it. We talk about that all the time. Now I'm meeting with a lot of clients right now, a lot of business owners, a lot of executives, high income earners, the whole spectrum. And so are our advisors, right? And now they're talking about, okay, it's too late for last year. I get it. I filed or I extended, and now I'm doing estimated quarterlies. So the second reason was I'm like, okay, now let's talk about tax planning for this year and for the long-term future. It's a good time for that. And so I'm like, well, this is a perfect thing. You talk about this stuff all the time, Jason. I thought it'd be a good topic.
Well, most people are doing a lot of things right? They get diversified. They have a financial advisor who helps them, get the right asset allocation, but then they aren't taking that extra step, which is tax planning within the investments. And so we're going to hit that today. And you can look at a 7%. We have a lot of studies that show 7% turning into 5 or 7 turning into 6 because of not exercising tax strategies within your investment portfolio. And above and beyond that is even your life, entity structure, taking the proper deductions, so on and so forth. So Brian, let's just pop in and look at a really simple growth of $500,000 chart. If you take a look at this, if you had $500,000 and you were able to eke out an extra 2% return over 15 years, you have either 1.2 million or all the way up to like 1.4, 1.5 million, just from an extra 2% growth over even a short period of 15 years. So this is something that should be started when you're young and should be carried on throughout your whole investment portfolio and your whole life. So as we dive into it, like, what is a tax drag, right? The erosion of returns due to taxes, because you have dividends. Those are taxed a certain way. Interest, by the way, stocks pay dividends, bonds pay interest. Interest is also taxed as ordinary income, which is ugly. We don't like that. That's the highest tax rates. You have capital gains, which can be taxed at a lower tax rate, up to 20%, depending on your income. So you've got to be aware of these different types of incomes. And then you have to go do things in your portfolio to make sure you're minimizing the amount of tax, which we're constitutionally allowed to do, exercise our right to pay the least amount of tax possible. So there's optimized portfolios, and then there's portfolios that are really not optimized. And I think one of the best things is we just kind of hit this off, because I think this comes up a lot at the end of the year, Alex, where people say, should I tax loss harvest? I was so happy. I got a couple of calls this last few weeks when the market was volatile, and had clients not concerned about the volatility, but they said, hey, you always talk about tax loss harvesting. Are we doing it? And I'm like, already did.
It's working. It's working.
Yeah.
They're listening. They're listening to you.
It was really quite beautiful to see the client lead that and say, hey, I want to know if we're doing that. So we have and I want to walk through this and give you a little visual. Perfect. Brian, thanks. Producer Brian on the back end, just always crushing it for us.
On the ones and twos.
Boom. There you go. So looking at this, how do you reduce your tax exposure? So here's a scenario 1, scenario 2 type of situation. If you have a fund, this could be an ETF, a mutual fund, it could be a stock, individual stock, whatever it is, and you have a gain of $10,000, we used a couple 37% marginal tax rate, you would pay $3,700 in taxes. That's just the cost of doing business, so to speak, or the cost of taxes with a portfolio. But if you were being smart about your portfolio and you were looking for opportunities, not just at the end of the year, but throughout the year, to harvest losses when something is temporarily down, a position in your portfolio is down, we paint that scenario in scenario 2, where you sell the fund of A, you have a gain, and maybe this is because of a rebalance, maybe it's to create regular income. You could sell it for a multitude of different reasons. But when you sell B at a loss, that offsets the gain, and therefore you pay 0 taxes.
How often does a do-it-yourself investor have to be looking at their portfolio to really do this correctly?
I think you got a minimum of weekly. We scan portfolios daily. That doesn't mean that we do tax loss harvesting daily, but we have parameters set up so we can look through every client's portfolio, every position owned, and we have parameters. Let's just say it's 5% down or a $5,000 loss. When we see that, we immediately effectuate that. So we're doing it on a daily look, but I think, even weekly is probably decent.
Another question on this, and this is for, I'm speaking directly to those listening that don't have an advisor like us that does look at this daily through software, right? What about we've done a lot of studies on our competition, for example, on robos. Let's pick on robos for a minute since they're robots.
How often they're not sensitive to us picking on them.
Right. Hopefully not. So how often have we learned in some of these studies, like some of these bigger, like really well-known names, like how do they do this kind of tax loss harvesting?
I don't know what you're referring to right there with the bigger names. If you're talking like wirehouses or whatnot.
No, the robos that
oh.
either that maybe they've bought the wirehouses that bought the robos, or they're just
sure.
standalone. Yeah.
Okay, good point. My understanding, and I could be wrong, so I'm not disparaging any competition, but I've seen a lot of rebalancing strategies where, let's say, your portfolio, one piece of your portfolio is off by 5%. Then they'll rebalance the whole portfolio back to your core or target allocation, which is really not smart because you just did a bunch of trades. There's cost to trading, whether there's a cost or not. There's an internal behind the scenes cost. And you created a bunch of unnecessary taxes because you rebalanced the whole portfolio because of one tax loss or one rebalance. So that's
another one is we've read about some of them that just do this quarterly, no matter what's happening. They do quarterly tax loss harvesting, or they scan for opportunities.
Yeah.
So they're not looking at it, not even weekly or monthly. It's just it's 4 times a year, or it's only at the end of the year only, or only at the beginning. Well, not the beginning of the year, the end of the year. But so it's important that you have to be nimble. You have to be paying attention, because markets, like we saw back in March. I mean, look at what happened in just Thursday and Friday of that, like middle week of March, I think it was.
Well, yeah, you mean you survived the recession, Trump recession of 2025, which lasted 2 days?
But what an amazing opportunity to harvest taxes for those that have large gains that they anticipate this year, to offset short-term gains or long-term gains, or even be able to have that for future rolling years forward. It's only $3,000 a year after the first year, right? But still something.
But I mean, yeah, the time is now, is your point. And if you have a quarterly tax loss harvesting strategy, it's not enough. Yeah. Because your portfolio could have a serious downturn that lasts for a week, a month, 2 days, 2 months, and then by the end of the quarter, maybe it's back up. You lost that opportunity to tax loss harvest, and it doesn't mean you're timing the market and you're going to cash.
No,
it means you're literally selling a position and then buying a secondary, a tertiary position, something that looks and acts similar, but is not substantially the same. So you don't change your portfolio construction. You don't change the targeted rate of return of your portfolio. You're just taking that loss, putting another position in that works close to the same. And now you get to save money in your pocket. I like to say it is like the tax loss is literally a coupon, a cash coupon that you're putting in your pocket. You get to use at the end of the year. So you want to do it all throughout the whole year, whenever you can, as often as you can, whenever there's those losses present themselves. So it's a really great strategy that needs to be deployed. Studies from, I'm just going to quote generally here, like you look at, I believe it was Investnet, I believe it was Russell, and also Vanguard did studies on the power and effect of proper tax loss harvesting. And I think they gave it somewhere between 0.25% and maybe up to 1%. Just by tax loss harvesting
per year.
You could add that extra return to your portfolio. So no brainer. You got
not about how much you make, it's about how much you keep.
Right.
So what's the next one?
I think we roll straight into, let's look at tax sensitive asset location. That's going to be, I think, the other numbered slide there, Brian. You can throw that up. But
I see it, yeah.
Missed all the time. Missed almost, well, I can say that of 27 years of doing this and thousands of clients, I've seen a handful of clients who have their accounts set up, incoming clients, our clients are set up correctly, but new clients to the firm, maybe a handful who have this truly set up the right way across.
It's even more complicated, this part, right? I mean, seriously.
Maybe not. I mean, yeah, you're going to have different types of accounts. We're showing this on a slide if you're watching on YouTube or whatnot, but you have accounts that are tax-free accounts. That's like your Roth IRA. Then you have accounts that are tax deferred, like a traditional IRA or 401k. Then you have accounts that are taxable, like your trust or your joint tenants with rights of survivorship, after-tax money. Really critical that you put the right assets and the right asset type in the right account type. For example, if we talked about a minute ago how ordinary interest, which is paid by bonds, is taxed at ordinary income rates, you don't want those ordinary income, that interest hitting your taxable account. So a logical place to put that to us would be in your IRA. It's a tax deferred account. So when that interest hits, then that interest is tax deferred. You don't pay tax on it. Whereas if I have like a US equity position that's a long-term hold, that's a growth position, doesn't pay any interest, small dividend, that's a great position for your taxable account.
Question.
Yeah.
So because if I were to be, and I've read these books and seen these articles, and so there's a conventional thought that in your retirement accounts, your pre-tax accounts, you kind of want to be more conservative, perhaps. I've heard some people say that. I'm not saying I agree with that or we agree with that, but that's counterintuitive to what you just said, because a bond that kicks off interest, you're saying could be more tax advantaged in that IRA or that 401k.
Yeah, there's different opinions on this. I think that other opinion is wrong, and I feel pretty strong about it, because if you think about your IRA too versus your taxable account, do you own 100% of your IRA? Is that all your money?
Unfortunately, no.
Nah. So the government owns part of that because you haven't ever paid tax on it, and you owe the government tax. So if you have $100,000 or $1 million in your IRA, you own about 70% of that. The rest is the IRA. So if I'm going to have an asset that grows the most, that has a higher growth potential, do I want to grow something a lot that I'm giving 70 or 30% of that to the IRS? Yeah. Or would I rather have my growth assets in an account that is all mine, AKA, or mostly mine, the trust account, or even better, a Roth. So, yeah. Which is the third part of the equation, Alex, right? Is your most growth-oriented assets you'd want to put in your Roth. Over long periods of time, small cap tends to outgrow large cap. You may get some emerging market or higher potential growth investments would be inside my Roth. My lowest growth, least tax efficient would be in my IRA, and my most tax efficient long-term growth assets besides the Roth juicy ones would go into my trust account. This also, real quick, this also, same study by Vanguard, Investnet, Morningstar, said that this can add, another maybe 0.25% to 1% of additional returns just by making sure that your asset location is set up.
I was going to say another layer to that too, just to kind of promote what we do, I guess. So, but honestly, to do it the right way, in years like 2022, when almost every single asset class was down the whole year, what an amazing opportunity towards the end of that year, especially, to do a Roth conversion, right? To actually take something that was almost everything was down. So you had to be pretty unlucky to get this wrong, but to convert some money or some shares of something that's super growth oriented into a Roth form, where now it could, when it rebounds, because it will, right? It comes back tax-free. All that growth comes back tax-free. That would have been a really, and that's what we did, obviously, for our clients.
Yeah, beautiful. It's amazing. You're talking numbers too. Don't ignore this.
Yeah.
I know finance can be, in investing and these topics can be a little overwhelming and even boring. I watched one of our podcasts last week and I'm like, damn, that's boring. And then somebody called and said, that was the greatest show. And I'm like, well, that was a great show. I was so bored. But this stuff is
too self-critical, Jason.
Maybe, but it can be boring. But you cannot ignore this, because we're talking about, if you have 500, a million, 2, 3, 4, 5 million, $10 million, $20 million investable accounts, the impact of these things we're talking about are gigantic. They're hundreds of thousands of dollars or millions of dollars in your portfolio over your life. So these can't be neglected. If you need help doing it, find somebody like us here at IDA to help you, or find an advisor who's talking about these kind of things, because unfortunately there's some complacency in the advisor world, and there's it's not always done. So let's just hit the 5 mistakes. We'll recap it, Alex. Why don't you nail those real quick? The 5 common mistakes.
I don't know if we hit them all, but I'm going to say them and then we can hit the ones we didn't hit yet. But so holding tax inefficient assets in taxable accounts.
Yep, not smart.
Neglecting tax loss harvesting, or doing it in a way that's just not intelligent.
Yep.
Using mutual funds instead of ETFs. So I don't think we hit that one yet. Yep. We'll come back to it. Failing to plan for step up or gifting, that could be huge. And then not using charitable tools when and if appropriate, like donor advised funds or qualified charitable distributions, for example, right?
So let's keep it short and sweet. But mutual funds versus ETFs. The problem with mutual funds is there's embedded gains and sometimes embedded losses, but over longer periods of time, and the longer a fund's been around, it has embedded gains. I've seen examples where somebody buys a mutual fund in June or July, or August, September, whatever, and that thing goes down 10%. And then at the end of the year, they're issued a capital gain. They have to pay tax on an investment that they bought and lost money in. Like nothing could be worse, right? You bought an investment, you're temporarily down, and now you have to pay tax because inside that mutual fund, they sold an investment that created a gain. And because you were holding it on the tax date, boom, you get issued your percentage of that gain. So really tough situation. That does not happen in ETFs. So ETFs, exchange traded funds versus mutual funds, are radically more tax efficient. And so that's the place you got to be. We don't need to unpack that more than that. Just know that there are certain times where you can't find an ETF, and there are certain advantages to mutual funds that can be debated over ETFs. But in general, particularly in a tax sensitive account, you would not prefer to own a mutual fund over an ETF.
And I'm going to put a teaser out there just for the next show, maybe even is those of you listening that actually have embedded gains within positions. ETF 2.0, I'll call it. I just made that up, by the way. It's not really a thing, but ETF 2.0 is like a direct indexing strategy. Or maybe even if you're a highly comped executive and you get kind of RSUs through your publicly traded company, maybe there's an option strategy that even is like an ETF 2.0, I'll call it. But again, very simple way of thinking about it. But there's other things if you're in one of those unique situations that we do for people all day, every day. We teach you about it.
Yeah, good. The other one you hit on, Alex, I think before was failing to plan for step up or gifting.
Yes.
And you got to think forward on this. This matters, right? When somebody passes, there's a step up in basis. I've seen people sell a piece of real estate late in life that had gigantic gains when if they had just held that for one more year, they didn't even need the money. They were tired of owning it. Hire a property manager, do whatever. Hold that till death. At death, it's a full step up in cost basis. The heirs could have received that with the current value as the cost basis, as opposed to them paying hundreds of thousands of dollars of tax in gains. So be smart about step up and how you're going to transfer assets. And also the gifting, the last one you talked about was not using donor advised funds and charitable. I can tell one story about a really smart client. And he, doing a review, he said, I'm going to give this money at death. I got $1 million I'm giving at death to this charity. And I'm like, yeah, but you're in your peak income years now. Why wouldn't you give that million today to a donor advised fund? You get the tax deduction today. That million is going to save you roughly $400,000 on tax. And said, I can do that. And I said, yeah. And you don't even have to give it to the charity today. You can give it to them still when you die, or it'll grow. That million will now grow to probably 2-3 million by the time you die. So now you actually get the tax deduction today and give a multitude of assets to the charity. We did it. He saved $400,000 roughly on his tax return by giving that today that he was going to give anyway. So those are really cool and powerful assets, especially for the higher net worth clients that we work with and when you're philanthropic and whatnot. So you got to be smart about that. We can help you do it. We got to keep moving here. What do elite or intelligent investors do? Kind of the opposite of what not to do. We just went through them, right? Implementing asset location, getting the right assets in the right accounts, using real-time tax loss harvesting, potentially using personalized or custom indexing can be pretty dramatic if you're a high income earner and have larger portfolios. Leveraging donor advised funds and appreciated stock gifting. If you're gifting to charity, don't give cash, give appreciated stock. It's the only way to give money to a charity, because now you don't have to pay the gains on that and you get to keep your cash. And then I think having your CPA and your advisor integrated and communicating. If they're not at the same firm, like they are with IDA, we have CPAs in-house, do tax returns, do tax planning, tax management. But if they aren't, request that they communicate and collaborate. Like your CPA should be talking to your investment advisor. They should have a relationship. It's really important. It's why super wealthy people have family offices where they have their attorney, their CPA, their advisor, and investment team all in the same house. That's called a family office. It's like building a wealth management firm for yourself. That's what the wealthy do. That's what we do for our clients, even with $1 million in investment assets. We're really bringing the family office experience to them. So that's cool. You've got to do that. We could show the tax loss harvesting. I don't think we need to do that. I think that's really it, right? You've got to think about these things. They're monumental and they are consequential in your life, even though they may seem like a little bit right now, or just I don't need to focus on that kind of thing. You really do. Even if you have a $500,000 portfolio, even a couple $100,000 portfolio, and you just have your money at Schwab or Fidelity, you should be exercising these things.
I want to throw out a call to action for anybody who's even remotely interested in part of what was just explained. I think one of our financial planning team's most fun exercises, I sincerely mean this, they love when a prospective client says, here's my stuff, show me how you could help me. Like, that's the simple thing you could do, is reach out, go to our website, email Jason at financialdetox.com, and put us to the test and see if we can show you what we're talking about to your situation specifically.
Yeah, that's it. You got to get involved. You got to have somebody look at this. Second opinions matter so much. Getting somebody else, even our clients, if they ever say, hey, I'm getting a second opinion, I say, great. Because I think that in the end, they end up seeing what we're doing for them and how we're doing it, and that it's great. But you should be getting a second opinion, have somebody else look at it. And that's what we're offering. Every day we do this show, we'll let you sit down with obviously no cost, no obligation, all that stuff. But the bottom line is, you'll get to see your world illustrated through a cash flow plan. You'll get to stress test these things and learn a lot about how to avoid toxic advice and manage your wealth for maximum impact. So we're going to wrap it up right there, Alex. Keep it short and sweet. It's Financial Detox. Click to learn more. Check in with us. We'd love to chat with you. Thanks as always. And give us a like if you would. Cheers.